Assalamu alaikum, dear students. Let's just start from the homework. I strongly believe that you people have attempted part A and now you're watching this lecture. Let's first try to deal with part A and then B, inshallah. Initial investment is 1,50,000, residual value is 30,000. Project life is 3 years. Company uses 20% written down value for depreciation. For tax appreciation, tax is paid with a delay of 1 year. Tax rate is 30%. And the first assumption is company is making an investment at the start of accounting period. And I said previously, I think many times also, this is the case in 99% questions. Okay, let's deal with part A, time. Project life is 3 year, but the impact goes till 4 because tax is paid with a delay of 1 year. T1, T2, T3 and T4. Let's take capital allowances, another name for the tax appreciation. Capital allowances. Then tax savings. Amount of the investment is 1,50,000. 150 into 20%. It is 30,000. For the second year, you can do one thing. 30,000. Take 80% of this, which is 24,000. Since the project life is 3 years, so in year number 3, in the last year, you have to take the balancing figure. Because according to IE 16, property, plant and equipment, only depreciable costs should be depreciated over the useful life of the asset. And over here, the useful life is 3 years. So 1,50,000 is the cost. That is 150. Minus the residual value, which is 30,000. So the depreciable cost is 1,20,000. From this 1,20,000, I will deduct 30,000 and 24,000. So in the last year, we'll get a balancing figure. Slowly and gradually, just after maybe two or three more lectures, we will be solving our questions, inshallah, on Excel. Don't worry at all. So 1,20,000 minus 30,000 minus 24. The balancing figure which I'm getting is 66,000. Since tax is paid with a delay of 1 year, so that is why the tax saving will arise from the second year. So 30,000 into 30% is 9,000. If I take 30% of 24,000, it is coming 7,200. If we take 30% of 66,000, it is coming 19,800. It is coming 19,800. Okay. Now let us deal with part B, in which the question says investment is made at the end of accounting period. Part B. Again, you have to make 3 columns. Time, capital allowances, and tax saving. Now listen and listen carefully, dear student. Number one, I did mention just right now also that investment is made at the end of accounting period. It hardly comes in exam, but still it's better to have the understanding what happens if investment is made at the end of accounting period. Actually, when investment is made at the end of accounting period, then you will start counting the time period from T0. Why T0? I'll tell you. Don't worry at all. T0, T1, T2, T3, T4. Why T4? Because tax is paid with a delay of 1 year. So the biggest difference, whenever investment is made at the start of accounting period, you will always start the tax saving calculation from T1. But when your examiner, if your examiner says, which is not the normally case, if your examiner says no, investment is made at the end of accounting period, then you will always start the working from T0. What is the logic? What is the reason why we start from T1 when examiner says investment is made at the start of accounting period, and why do we basically start from T0 when investment is made at the end of accounting period? Let me first numerically complete part B, and then I'll give you the logic as well. So far till here, you just need to remember one thing. If question says specifically that investment is made at the end of accounting period, then you will start tax saving calculation from time 0. So 1,50,000 into 20%, it is 30,000. %80 of this is 24,000. Then again, we have to take 80% of this. So 24,000 into 80%, that is 19,200. In the last year, you have to take the balancing figure. Cost is 1,50,000 minus the residual value, which is 30,000. Depreciable cost is 1,20,000. Last year balancing figure. So from 1,20,000, you need to deduct 1,20,000 minus 30,000 minus 24 minus 19,200. So we are getting 46,800. Now tax saving. Since the tax is paid with a delay of 1 year, so 30,000 into 30%, tax saving will arise from T1. So that is 9,000. T0 tax will be saved in T1. So 24,000 into 30% is 7,200. 19,200 into 30%, that is 5,760. And 30% of 46,800. It is 14,040. So now you can just see the difference in calculation when if the examiner says or question says specifically that investment is made at the end of accounting period. Then what is the case? Okay, now let us try to discuss the logic. What is the logic behind this? When examiner says investment is made at the start of accounting period, why do we start tax saving from capital allowances from T1? Second, if the question says investment is made at the end of accounting period, then why do we start tax saving calculation from T0? What is the logic behind this? Let me explain that. When investment is made at the start of accounting period, now listen, why T1 comes in the calculation? Assuming this is the accounting period, let's say. Okay. And the day of investment is this. Assuming the accounting period is from 1st January 2024 till December 24. Okay. We are making investment on this day. Obviously, the day when we are making investment, it is the start of the accounting period. Okay. Now the problem is when you calculate capital allowance, another name is tax depreciation. So basically what you have to do, you have to claim that capital allowance. How do we claim that capital allowance? Basically, you need to deduct that capital allowance. You have to show that capital allowance into the income statement. But the problem is you have made an investment on 1st January 2024. You can calculate tax depreciation on 1st January 2024. But the problem is on a very first day of the accounting period, income statement is not prepared. Actually, income statement will be prepared exactly after 12 months. So logically, from the date of investment till the preparation of income statement, you have to wait for the 12 months in order to claim the tax depreciation or the capital allowance. Since the P&L of December 2024, income statement, profit and loss will be prepared on this date. So from point of investment till the P&L, you have to wait for 12 months, or you can say 1 year. Since from the date of investment till the end of accounting period, when the income statement will be prepared, we have to wait for the 12 months. That is why whenever investment is made at the start of accounting period, you will always start tax appreciation, tax saving from the capital allowances calculation always start from T1. Actually, T1 is representing that you had waited for 12 months for the income statement, because without the income statement you cannot claim the capital allowance. So this T1 is actually representing that from the date of investment till the preparation of income statement, you waited how many months? 12 months. Now let's see, if the investment is made at the end of accounting period, then what happens? Investment is made at the end of accounting period. So an investment is made at the end of accounting period. Now try to understand. Assuming this is your accounting period, and let's say we are making investment on this date. Now listen and listen carefully. Since you are making an investment at the end of accounting period, since you are making an investment at the end of accounting period, so the income statement is actually already prepared. Income statement is already prepared because you are making an investment at the end of accounting period. So from the date of investment till the preparation of income statement, there is no need to wait, because P&L is already prepared. The income statement is already prepared. All you need is just calculate the capital allowance and claim in the income statement. Since you're not supposed to wait for the income statement because it is already prepared, that is why when we start the calculation for tax saving from capital allowances, you will always start from time 0. T0 is actually representing that you did not wait for the income statement because the date of investment is at the end of accounting period, and at the end of accounting period, income statement is already prepared. So that is the logic. Why do we start from time 0? When organization, they make investment at the end of accounting period, and we already discussed why do we start from T1 when organizations, they make investment at the start of accounting period. So normally in 99% questions, investment will be at the start of accounting period. In fact, if nothing is mentioned, then you will always assume that investment is made at the start of accounting period. I've given you the logic as well, and other than the logic, you just try to memorize, remember one thing. What is that one thing? Whenever investment is made at the start of accounting period, always start the calculation from T1, which is the case in 99%. 99%, that is what happens. What happens normally. But if examiner says we are making investment at the end of accounting period, then you will start the calculation for tax saving from capital allowances from time 0. So at least try to remember these things. Now, we have discussed basically principles of calculating NPV, that you have to work on relevant cash flows. We did discuss, there was entire one lecture on capital, I would say relevant cash flows. Second, we did discuss there are 2 types of cash flows, real and nominal. And we have also seen how to convert real cash flows to nominal, or in case if you have let's say if you have been given a real cost of capital, then how to convert real cost of capital to the nominal. We did discuss that also. And we have also discussed how to calculate tax saving from capital allowances. Now the time has come that we should start doing properly past paper questions from the kit. So, and also let me show you the kit also. I hope that you can see the kit. Let me show you the first cover page of the kit so that you should be having an idea that actually we are doing a latest kit. You can see this is basically September 23, December 23, March 24, and June 24. This is the BPP kit which I'm discussing with you. So it's a latest kit. You can see that validated 2024. Okay. Now let's go back to here. Let me discuss just a minute. Here comes the question also. Number one, you can see that we are discussing a past paper question and from the latest kit. Okay, this kit is valid till June 2024, which we have seen. Pelta company, it came in September, December 2017. Requirement A1, calculate NPV of the plan investment 9 marks. Discounted payback period, we cannot solve right now because we did not discuss payback. Discuss the financial acceptability of the investment. Yes, we can do that. Obviously, if the project is generating positive NPV, we will accept the project. Organization should opt the project because it will increase the wealth of the shareholders. Critically discuss the views of the directors on Pelta investment appraisal 6 marks. We will see that if the part C, let's say, relates on other than NPV, then we will not be discussing right now because we have just discussed, we have only discussed the basic principles of NPV. So it's a first question. Let us right now just stick to NPV. The directors of Pelta company are considering a plan investment project costing 25 million. So that is your initial investment. Payable at the start of the first year of operation. They're making an investment at the start of accounting period. The following information relates to the investment project. Sales volume, I'm ignoring 3 zeros, 520, 624, 717, 788. Selling price is 30, 30, 30. Okay. Variable cost per unit is this. Fixed cost 700, 735, 779, 841. Okay. This information needs adjusting to take account of selling price inflation 4% per year. So you have to incorporate inflation 4% per year in the selling price. Variable cost inflation is 3%. The fixed costs which are incremental, basically incremental fixed costs, additional fixed cost is always relevant. The fixed costs which are incremental related to the investment project are in nominal terms. Nominal terms means with inflation. Since the fixed cost is already in nominal terms, that is why you're not supposed to incorporate any inflation into the fixed cost because inflation is already added to the fixed cost. Okay. The year 4 sale is expected to continue for the foreseeable future. Fine. Pelta pays corporation tax 30% 1 year in arrears with a delay of 1 year. It means T1 tax will be paid in T2. The company can claim tax allowable depreciation 25% reducing balance basis. Okay. The views of the director of Pelta are that all investment project must be evaluated over 4 years of operation with an assumed terminal value at the end of 4 years 5% of the initial investment. So basically the residual value is, let's say they are saying your initial investment is 25 million. I'm ignoring 3 zeros. So your initial investment becomes 25,000. If I take 5% of 25,000, that is going to be my residual value. It is 1250. So the residual value of this project is 1250. Both NPV and discounted payback must be used with a maximum discounted payback period of 2 years. The real after-tax cost of capital is 7%. The nominal is 12. Now listen carefully. Right now, do not think anything about payback. We did not study yet. Another thing, since in the question, more than one inflation rate is given. That is why you have to convert all the real cash flows to the nominal. And once you have nominal cash flows, then your discount factor has to be nominal. Examiner has given you the real cost of capital as well as nominal. Since we are supposed to incorporate inflation to the selling price as well as to the variable cost, and fixed cost is already inflated. Fixed cost is already in nominal terms. So since all the cash flows, they will be in nominal terms. So that is why you have to use the discount factor, which is nominal. So let me first show you the working one relating to the selling price. Sales. Just ignoring 3 zeros. T1, T2, T3, and T4. Demand, let me ignore the 3 zeros. I'm 520, 624, 717, 788. Selling price per unit. What is the selling price per unit? It is 30 each. Inflation. Since it is mentioned in the question that you have to incorporate inflation, so inflation comes from the first year. Selling price inflation is 4%. So simply multiply this with 1.04, 1.04 power 2, power 3, and power 4. You will get sales amount. So 520 multiplied by 30 into 1.04, I'm getting 16,224. 624 multiplied by 30 into 1.04 power 2, I'm getting 20,000. 247.5, so make it 48 with a little bit rounding off is acceptable. 717 multiplied by 30 into 1.04 power 3. 24,196. 788 into 30 into 1.04 power 4. 27,655. Now let's try to calculate the variable cost. Working to is variable cost. Time T1, T2, T3, and T4. Demand, obviously it is same. We are not, it's the first question I'm not solving on Excel, but few questions we'll be solving on Excel. So in Excel, you can use the copy paste option. But right now we are solving them manually. 526, 24, 717, and then we have 788. Variable cost per unit. Variable cost per unit is 10, 10.2, 10.61, 10.93. Okay. It is 10, 10.2, 10.61, then 10.93. What is the inflation rate? I think it is 3% per annum. Inflation. This information needs adjusting to take account of selling price inflation 4% and variable cost inflation 3%. Simply power 2, then I'll take power 3 and power 4. So 520 multiplied by 10 into 1.03, that gives us 5,356. 624 multiplied by 10.2 into 1.03 power 2. I'm getting 6,752. 717 into 10.61 into 1.03. The power is 3. I'm getting 8,313. 788 into 10.93 into 1.03 power 4. We are getting 9,694. Now let's go for working 3. Tax saving from capital allowances. Time. Capital allowance, another name is tax appreciation. Tax savings. Project life is 4 years, but the impact goes till 5 because tax is paid with a delay of 1 year. We have ignored 3 zeros. So I'll take 25,000, which is the initial investment, into tax appreciation percentage is 25% reducing balance. So 25,000 into 25, I'm getting 6250. 6250 into 75%. 4,688 with a little bit rounding off. Then 75% of this. I'm getting 3,516 again with a little bit rounding off. T4 is the last year, so you have to take the balancing figure. Cost is 25,000 minus the residual value, which we have computed 1250. So 25,000 minus 1250, that gives me 23,750. From 23,750, you have to deduct 6250, 4688, and 3516. 6250 minus 4688, 3516. The balancing figure which I'm getting, that is 9,296. What is the tax rate? Tax rate is 30%. So simply multiply this with 30%. But your first tax saving will arise at T2 because tax is paid with a delay of 1 year. 30% of 6250 is 1875. 4688 into 30%. 1406. 3516 into 30%. 10,500 and 1,055. 9296 into 30%. 2789. Okay, we have done the calculation. Now let's go to the proper format to calculate NPV. So let's calculate NPV. Time T0, T1, T2, T3, T4, and T5. Let's ignore 3 zeros. First of all, we have to take initial investment. Outflow of initial investment is 25,000. Sales working 1. T1 sale is 16 224. 16,224. What is the amount of T2 sale? 20,248. T3. 24,196. 24,196. 27,655. Variable cost is working to 5,356. 6752. 8313. 9694. Let us deduct the fixed cost. Incremental fixed cost, additional fixed cost is always relevant. And the fixed cost is already in nominal terms, means fixed cost is already with inflation. It is mentioned in the question. Let's take the fixed cost from the question. First year fixed cost is 700, then 735. 700, then 735. 779, 841. 779, 841. Let's calculate taxable profit because tax is paid on taxable profit. 16,224 minus 5,356 minus 700. I'm getting 10,168. 20,248 minus 6752 minus 735 gives me 12,761. 24,196 minus 8,313 minus 779. I'm getting 15,104. 27655 minus 9694 minus 841. I'm getting 17,120. Now tax payment at the rate 30%. Since tax is paid with a delay of 1 year, so the T1 tax will be paid in T2. How do we calculate T1? How do we calculate tax? Taxable profit is 10,168. You can see in T1. Multiply by 30%. I'm getting 3,050. Then 12,761 into 30%. 3,828. Then 15,104. 15,104 into 30%. That is 4,531. 17,120 into 30%. That is 5,136. Okay. After calculating the tax payment, now you have to just simply take tax saving from capital allowances. Tax savings from capital allowances, tax savings from tax appreciation. Working 3. The first tax saving which we have already computed is 1875. Second tax saving is 1406. Third, 1055. Fourth is 2789. Residual value is inflow. Scrap value, residual value will always be written in the last year of the project, and the last year is actually T4. Residual value is 1250. How did I calculate 1250? It is mentioned in the question that residual value, scrap value is 5% of your initial investment. Your initial investment is 25,000. If you take 5% of 25,000, obviously it is 1250. Now let us calculate net cash flows. It is 25,000 negative. In T1, it is 10168. T2, 12,761 minus 3050 plus 1875. 11,586. 15,104 minus 3828 plus 1406. I'm getting 12,682. 17,120 minus 4,531 plus 1055 plus 1250. It is 14,894 minus 5136, which is in the last year number 5, plus 2789. That gives me minus 5136 plus 2789. I'm getting minus 2347. Cost of capital, we have to use nominal cost of capital, which is given in the question, 12%. Nominal cost of capital is 12%. And cost of capital is after tax. Why after tax? Because your cash flows, whom you are discounting. Cash flows which we are going to discount, these cash flows are after tax. So that is why cost of capital has to be after tax. So the discount factor is 12%. 1.893797712636, and I think that is 579. Let me check. 1.12 power minus 5. Yeah, 567. Present value of net cash flows. That is 25,000. 10,168 multiplied by 0.893. I'm getting 9080. 11,586 minus 0.797. 9234. 12682 multiplied by 0.712. 9030. With a little bit rounding off is acceptable, no issue at all. 14,894 multiplied by 0.636. I'm getting 9,473 minus 2347 into 0.567. My 2347 into 0.567. I'm getting minus 1331. Now very easily we can calculate NPV, net present value. Simply you need to add all these 4 values and deduct the last and the first because they are in negative. So let me use the calculator. Minus 25,000 plus 9080 plus 9234 plus 9030 plus 9473 minus 1331. I'm getting a positive answer, 10,486. Since the NPV is positive, so this project is financially acceptable because it will increase the wealth of the shareholders. How do we do the drafting? How do we write on financial acceptability? It's very simple. Let me explain again. You just need to write two to three lines. Number one, you will be writing, since NPV of this project is positive, which will increase the wealth of shareholders. That is why this project should be acceptable. Simply repeat what you have to write in financial acceptability. That since NPV of this project is positive, which will increase the wealth of shareholders, that is why this project is financially acceptable. So actually in this video, I just wanted to give you the flavor, what type of NPV questions they come in exam. It's a very first question. Obviously, From here onwards, we'll be doing lots and lots of the questions, obviously from the kit, which are the past paper questions, in fact. But in this class, you can see one thing: we have attempted at least a past paper question, part A. And slowly and gradually, just after 2 to 3 more questions, we'll be inshallah solving our question on Excel. And I'll be using all those shortcuts, and I'll be teaching you inshallah all those shortcuts which are available in exam. So I really want you, after completing this video, please try to solve this question, practice this question at least once. So thank you very much for watching this lecture. Have a nice life.